Fidelity Bank's gross earnings rose by 6.2% in the first half of this year, and profit before tax jumped 72% over the same period. The release of the lender's results over the weekend adds to a growing list of corporate earnings that have failed to lift investors' interest in equities. Rotimi Fakayejo, Capital Market Analyst, joins me now to discuss why. Rotimi, thank you so much for your time. Now, in my intro, I suggest that those numbers have really failed to lift investors' interest. However, I'm hearing that in the case of Fidelity Bank, we did see a reaction today. Can you just tell us what you make of the results and how the market is likely to process what I think many will suggest are very good numbers?
Yes, I think basically for Fidelity Bank, it's proved to be different from the others. Vis-a-vis their interest in the earnings from their normal core business, which is interest income. And then, like most other banks that have released their results, we are seeing a downward trend in that particular space. And also, they really done well with respect to their fee and commission income and other operating income. And I think these are added likely to what we are seeing in the figures. And I believe investors have really perused the figures and have seen that there's so much value in the stock. And I think that is the reason why we are seeing almost about 5% increase in their share price today. But I think for what we have seen earlier on in the previous weeks concerning result release, I think some of those results are far from being impressive. And that's the reason why we have been seeing the long in the market for almost 2 weeks or thereabouts.
Right. And I think one of the significant results, in my view, the most significant, will be that of GT Bank. Of course, it's now a holding company where we saw their profits dip 15%. Typically, GT Bank tends to lead the way in terms of growth. Do you also think that was significant? And would you suggest that perhaps investors are paying attention to what the market leaders are doing?
Yes, because we saw the results coming out in succession. The first being Zenith Bank, which was quite acceptable to the market. Then came, I think, Access, which was equally good. Then Stanbic swept everybody off their feet, not in a positive way. And then now we are seeing, we saw GTCO. But I think what has really minimized the damage to the market is the result of Fidelity Bank today. So investors are actually looking at those figures. GT Bank is far from being impressive at this time. And I think investors are really concerned whether the whole cost structure is actually a plus or a minus, and also the succession plan, that is whereby the new MD is coming in and the old MD, the outgoing MD, is still retaining his position as GMD of the GTCO. I think corporate governance is being called to question at this time. So I think investors are really looking at that coupled with the results.
So all that considered, and as you know, Nigeria is going to hit the road shortly in terms of the finance minister and the rest of that entourage to speak to investors about the Eurobond issue. Many have suggested is very positive for the economy, especially with respect to foreign exchange. Do you think that could have any significant impact on sentiment for the equities market?
Well, it may not, because we are waiting. We are not being pessimistic, but we are waiting for what the outcome of the Eurobond roadshow or whatever is going to be. Because the price that is going to come to the Nigerian economy, to the Nigerian government, is going to be high vis-a-vis our credit rating. So if it's high, then I don't think it's a plus for the equity market. But if it's average, if they still consider it very okay, at least those who will be taking up the Euro bond, I think it may not really have much of an impact on the market. But all in all, I think everybody is really on the watch for the Nigerian economy and also the equity market. So with all of this, I believe we can still hold our heads up. I believe in that those who didn't do well in the half year may really be able to push up by the time we see the full year result for most of the equity stocks. But for the success of the Eurobond, I think it's really being called to question whether it will succeed or not.
All right, so I have to put you on the spot. So all that said, would you will you suggest that investors buy into the dips in performance that we're seeing in some banking stocks in particular, or do you think that they should wait it out and see what happens with the Q3 numbers before they get invested?
Well, I would suggest that investors should do cherry picking. I should cherry pick whatever securities that they want to do and not make a global assessment. So just take stocks on their own merit and go through the figures and do a forecast of what we'll be likely seeing Q3 and Q4. Then I think they will be able to make a valid and a valuable decision concerning that.